Hello again. It's probably been a little while since you viewed one of the videos. We finished the videos for our Business 101 class for test number 3, chapters 12, 13, 14, 15, 16, and bonus chapter B. And you took the test number 3. Now we are finishing the semester. We're going to be in chapter 17, 18, 19, 20. And bonus chapter D as in dog. I'm going to do these videos for these chapters just like I did the ones for the previous chapters. We're going to talk about the chapters. I'll tell you those things to be familiar with. I'll tell you about those things to know and that type of thing. So welcome back. I hope you're still safe, doing well, and let's get into a chapter. This is a chapter by itself. But this is a chapter that we may not know a whole lot about. And so we need to really understand how important this is. I guess a question that I would ask you if you were a business owner, or I would ask you if you were even working for a business. Do you want your business or your company to be successful? I think I wrote that up here. Do you want your business to be successful? Now, obviously, the answer to that is whether you are the owner of that business or you are an employee of that business, the answer would be, well, of course. Well, then I guess my next question would be then, how can you tell if a business is successful? Well, it's successful if it has a lot of customers. Not necessarily. It's successful if it takes in a lot of revenue. Well, not necessarily. Well, it's successful if a lot of people know about it. No, not true. Now, you're probably already thinking ahead of me. Since y'all are already business people and economists, what's probably the best way to know if a business is successful or not? And that would be if that business is making a profit. If a business is profitable, then it's doing fine. It's going to continue. If you want it to continue, it's going to continue. But it has to be profitable. If it's not profitable, belly up. Okay, now y'all also know some other things, and I mentioned a couple of things going in here. We talked about profit in chapter 2, I think. Okay? You know, how do you determine profit? Well, profit is determined by revenue. Remember what revenue is? Money received from the sale of goods and services minus expenses. All the expenses of doing your business. Revenue minus expenses equals profit. If your expenses are greater than your revenue, what do you have? You've got a loss. Okay. So we know how to determine what profit is. All right, so if you're in a business, or if you own a business, is it a good idea to write down every bit of revenue you get in to make sure that somehow or other you keep up with all the revenue you get? Very important. Is it important that you write down all your expenses? Salary expenses, utility expenses. So you write down all the expenses that you have. Yeah. Okay. So if you write down all your revenue, and you write down all your expenses, if you subtract those expenses from your revenue, you'll know whether you have a profit or not. I know you're thinking, okay, got all that. So where are we headed? Well, here's what we're headed. In a company, writing down all the revenue and writing down all the expenses to see if you have a profit or not, what's that called? I'll give you a hint. Starts with an A. C. It's accounting. That's what now there's more to accounting than just that. Accounting is pretty complicated. We're going to hit, and by the way, you'll take accounting here at Delta if you're in our business and technology program. Accounting 201, really good course, and a principles of financial accounting, and a course that you have to finish our associate degree in business, because accounting is so important. You may not become a full-fledged accountant, but you've got to know enough about accounting to be able to analyze how your business, how your department, or maybe only your personal things are going. Okay. So accounting, if you're looking at your study notes, and of course you have study notes for these chapters, my definition of accounting was pretty tacky. I mean, it's a good definition, it just went all over the page. So I put the definition up here. Accounting is the recording, that's the writing it down, classifying, summarizing. Okay, let's take a business like Walmart. Do they write down all the revenue that they receive? Yes. But would they like to also maybe write it down by, say, menswear, or automotive, or pharmacy, or grocery, or electronics? That's kind of the idea of classifying it. And you know, there's a lot of Walmart stores. So maybe would corporate Walmart, or even the manager of a particular store, would he like to summarize maybe the major departments, the major things, and where that money came from, how much revenue they received, and that sort of thing. In corporate Walmart, do they want to know how each one of their Walmart stores are doing, their regional managers? So that's the idea of summarizing. Then you got to use this information. That's what interpreting is. Let's make sure we write it down, we classify it the way we want to, we summarize it however we would like for owners and management. Then let's make sure that we interpret that information, interpret that financial information, interpret all those financial transactions. Why? To provide management and others, maybe the government, maybe stockholders, information to make good decisions. And I probably should have put up here, to make good financial decisions. That's what accounting is. I'd be familiar, by the way, I'd be familiar with what accounting is. Okay, I think I put something over here. I just put 3 little words over here: inputs, processing, and outputs. By the way, this is probably the fullest that you're going to see this board on any of the chapters we do, I think. Because there's a lot of stuff up here as it relates to accounting. So just kind of stay with me as we move around. If you've ever, and I saw one of these not long ago, if you're ever driving down the road, sometimes these companies are hired to go and cut limbs that are hanging over power lines, so that if we have ice or snow or something like that, those limbs won't fall on those power lines and disrupt service. So they'll cut those limbs. Well, a lot of times, they'll have the machine that cuts the limbs, but they'll also have a big truck, and it's got this machine behind it. And they take these limbs and they put them in throw them in this machine. As this machine grinds those limbs up into sawdust, and sawdust comes out the other end and goes into the back of it, kind of like a pickup truck. Well, a pickup truck, if you were going down the road and you were cutting limbs, probably big limbs, before long you'd have that thing full, and you'd have to stop and empty it, and that would take a lot of time and effort. But if you can take those big limbs, throw them in those hoppers, or throw them into that hopper, and it come out as sawdust, you can put a lot more sawdust in the back of that truck. Now that's kind of a weird example, but not exactly, of accounting and kind of how the accounting process works. Okay? You take all those documents that have anything to do with you receiving money or expending money, information to do with payroll, any kind of invoice that you got, any type of receipt that you got, anything, because if you receive money, there's always a paper trail. If you go somewhere and you put money in the bank, they're going to give you something showing that you deposited that money. If you go to a store and you buy something, they're going to give you paper that shows you that you bought it. Well, those stores also have copies of that paper as well. Well, you got to gather up all that paper, everything that has to do with revenue, everything that has to do with the expenditures. You got to make sure you gather all that stuff up and throw it into the hopper, and then the hopper grinds it up. But out of the other end doesn't come sawdust. What comes out of the other end are financial statements and other financial information you need, your boss needs, owners need to make good decisions. You kind of get the idea? You kind of get the idea. That's sort of the idea of how accounting works. No, I didn't. It's here on your handout, and it's written pretty well except for one thing. So I want to go over this with you. Accountants are like doctors or lawyers. Most accountants specialize. They specialize in different areas. Accountants that actually work with accounting stuff, they work with doing balance sheets, income statements. We'll talk about what those are. But they actually do the accounting stuff. Those are called that number 2, financial accountants. Now, those people that take these financial statements and they interpret them to make good decisions, those are called managerial accountants. They work with management. Some people go behind the financial accountants that do these financial statements and record all this information and make sure they did it right. Make sure their financial statements are right. Those are called auditors. Taxes, your taxes are due April 15th, most years, April 15th. So are taxes something really a big part of business? Well, sure. So you have tax accountants. These are accountants that work primarily with tax. And some businesses have to be concerned, obviously, with taxes year-round. Now, the last one, if you're looking at your study notes, it kind of cut the top of it off. So let me give you the last one. It's government and not-for-profit accountants. You don't have your notes like this, but you have them in Canvas. But the first 4 are pretty easy to see. The 5th one I kind of cut off. That is government and not-for-profit. In other words, this would be for like Delta Community College, the City of Monroe, the Salvation Army, United Way. Do they do accounting too? Yeah, they do. Do they do it slightly different? Yes, because those folks are not trying to maintain or have a profit. They're trying to come up with what they call a fund balance for a particular cause or for a particular operation. Okay, so I want you to know the 5 different areas of accounting that you could go into if you want to be an accountant. You could be a managerial accountant, one that helps with the interpretation. You could be a financial accountant, one that does the recording and classifying and summarizing. You could be an auditor, one that goes behind to be sure that this stuff is done correctly. A tax accountant, which is an accountant that primarily works with taxes. You may have a tax accountant that prepares your taxes. And then a government or not-for-profit accountant. This is one that works with the kind of organizations we just mentioned. Okay. I wanted to show you something else here. Again, I would know those things. I want to show you something else here that our author called the accounting cycle. Now, I'm not going to get crazy about this. This is not going to be a know or be familiar with. But I just want to see if remember the input, processing, and outputs. Remember that hopper. Well, let's just break this down a little bit more. Okay. So here's how the accounting cycle works. The first thing is you have to analyze your source documents. That means all those pieces of paper, that we were trying to collect to throw into the hopper. You analyze those, make sure what they are, make sure they're complete, make sure you have what you need before you throw them into the hopper. So that's the first step of the accounting cycle. Then record transactions. You record every financial transaction. We talked about we need to do that to know whether our company is going to be successful or not. In 2020, who records financial transactions? Mr. Computer. When you check out at a Walmart and you've got that machine that they're using to help you check out, that machine is nothing more than a computer, accounting computer. You get a receipt for what you have and it records for what you bought, and it records that same information for Walmart and sends it into the accounting system. So recording transactions, that's done by computers today. It used to be done by hand. That would be tough. I'd be familiar with the fact that computers have had a huge impact on accounting. Accounting is done so much differently today, and computers have really had a huge impact. Post to the ledger. That's where you do the summarizing and classifying. Who do you think posts to the ledger? Mr. Computer. Computers do the recording, classifying, summarizing. Computers can't interpret, but they can do those things. So these are things that the computers do. Okay, take a trial balance. Let me tell you, and again, you've got a whole semester on Business 201, Accounting 201. So we're just going to get right to the surface. Take a trial balance. Have you ever heard of debits and credits? Well, you're just going to have to believe me on something here. Just trust me. And then the accounting professor, when you take Accounting 201, they'll explain it in greater detail. In the world of accounting, everything is posted twice. It's called a double entry bookkeeping system. Everything you post first as a debit, and then you post it as a credit. Almost think about it, I'm going to erase this, almost think about there's a line here. And everything is posted as a credit, everything is posted as a debit. If you go and as a business and you buy a piece of equipment, and that piece of equipment becomes yours, you're gonna debit and credit your cash, the equipment. There's going to be a debit entry and a credit entry. Okay, just take my word on that. So if every entry has both a debit and a credit, what should the debits and credits always do? Balance. Could there sometimes be a mistake where they weren't posted properly? Yes. So that's what take a trial balance is. Basically what taking a trial balance is making sure that you posted everything as a debit and a credit to the proper accounts. After you've done all this, and the computer does this, prepare financial statements. Computers can prepare financial statements to a point, but then these financial accountants that are overseeing all this, making sure all this is being done correctly, they also make sure that they prepare the financial statements properly. So that's where, here we are right now, is where we're taking stuff out of the hopper. Analyzing source documents, that's when we've got all those limbs in our hands. When we chunk them into the hopper is recording transactions, posting to the ledger, summarizing and classifying, taking a trial balance, preparing financial statements. That's computer stuff. Under the jurisdiction, I may say, of financial accountants. Then, of course, like we said, what comes out the other end is not sawdust, it's financial statements, and then managerial accountants can take those financial statements and analyze them. Okay. That sort of makes sense. We don't go any deeper than that. We just want to go to there. I'll just mention this, and I want you to be familiar with it. Bookkeepers, accountants do all these things. Bookkeepers do basically a portion of this. If a person, now bookkeepers are wonderful, but bookkeepers normally do not go through, record, summarize, classify, prepare financial statements, interpret. That's what accountants do. And so just be familiar with the fact that bookkeepers do a part of the accounting cycle, whereas accountants do all the things that are done within the accounting cycle. Just be familiar with that. Bookkeepers do a part of what accountants do. They do a part of the accounting cycle. Accountants do it all. And also be familiar with the fact that, matter of fact, I think I'll just get rid of this now. Just be familiar with the fact that computers have had a huge impact as it relates to accounting. Okay. What we've done here, and remember, I think number 5 here was prepare financial statements. Well, here are the two most important financial statements that are prepared for businesses. The balance sheet and the income statement. Now, I've given you on your handout, I put down here for you financial statements. I want you to be familiar with what financial statements are. Financial statements are a summary of all the financial transactions that have occurred over a period of time. These two things, the balance sheet and the income statement. These two things they are both financial statements. And what financial statements are, again, they're a summary of all the financial transactions. I realize I'm talking to the board, but about the only way I can do that. Summary of all financial transactions that have occurred over time. I'd be familiar with that. Just be familiar with what financial statements are, okay? One more thing that's a real biggie in the world of accounting. All right, let me go to the world of math. In the world of math, new math, old math, young math, old math, whatever math, 2 plus 2 still equals 4, okay? That's just the way it is. In the world of accounting, there's what they call the fundamental accounting equation, which I'd like for you to be familiar with. The fundamental, did I write it down for you? Yeah. The fundamental accounting equation says assets equal liabilities plus owner's equity. Assets equal liabilities plus owner's equity. Okay. What are assets? Do you know? What assets do you have? What assets do a business have? If you say, well, they've got a building, they've got cars, they've got trucks, that's right. So assets are really things that you own. Liabilities, if you have a liability, what do you think? That's what you owe. And owner's equity is what you are worth. All right. Assets equal liabilities plus owner's equity. Let me give you 2 examples of that. And again, just stay with me. I want you to be familiar with this, but just what we're talking about here. You go out and you buy a vehicle. You buy, maybe you can still see me here. You buy a car worth $50,000. So you have a $50,000 asset. You pay $10,000 down and you finance $40,000. Okay? So what is your liability as it relates to that car? It's $40,000. That's what you owe. What is your worth in that car? What do you owe of that car? $10,000. Because you paid $10,000 down. You see the idea? Assets equal liabilities plus owner's equity. All right. Now, I'm not going to write this next one, but let's do it this way. You go and you buy a $50,000 truck, and you hand the salesperson $50,000 in cash. They'd probably pass out, or let's just say you did. Okay? How much? What do you own? What's the worth of that asset? That asset that you own is worth, it's $50,000. What's your liability? 0. You paid for it cash. What's your equity in that vehicle? $50,000. Because you own it all. So I've done an example of where if you paid some down, if you own it all. Now, if some salesperson would be stupid enough to let you drive off the lot without paying anything down, let's say it's a $50,000 vehicle, they say, Joe, take it and go. Pay later. That's a great deal. The asset, what's the worth of how much is that asset? The asset is $50,000 asset. What's my liability? $50,000. What's my worth? 0. Because I paid nothing for it. That's the idea. Okay. So assets always equal liabilities plus owner's equity. So trust me on this. Whenever you buy something, whenever you sell something, whenever there's a financial transaction, it's going to affect something on the asset side. It's going to affect something on the liabilities and owner's equity side, because this always has to equal this. This is why you get debits and credits. Debits and credits. Okay. If you're confused, wind this back and replay it. It'll be. I think it'll be okay for you. All right. All right. Okay. So I want you. Let me back up. Make sure. I want you to be familiar with what bookkeeping is. Bookkeeping is a part of accounting. I want you to be familiar with the fact that computers have had a huge impact on accounting. I want you to be familiar with what a financial statement is, the summary of all the financial transactions that have occurred over a period of time. All right, let's look at these two financial statements that are so important. All right. Remember that fundamental accounting equation that I put up here? I'm not going to put it back up here, but I'm going to draw this. Just pretend, well, I'll put assets equal liabilities plus owner's equity. Let's take this financial, let's take this. Let's say I put this on a board. I stuck a board to this whiteboard, and I wrote the fundamental accounting equation on it. If I took that board off and came over here and stuck it vertically instead of horizontally, it would be a balance sheet. A balance sheet is really kind of an expression of the fundamental accounting equation. All right, so let's look at these two really important financial statements. One of them is a balance sheet. Now I want you to look at your handout or make a note to. A balance sheet shows a firm's financial condition at a given point in time. What is the worth of that company at a given point in time? That makes sense? You can do a balance sheet on yourself as well. You know, sometimes they talk about people being millionaires. Well, that's how they determine that, is by the financial statement. Let me show you how this works. So a financial statement, a balance sheet, is for a particular day, a particular point in time. A balance sheet, firm's financial condition at a given time. So this is what the financial structure, this is the financial condition of this company on 30 June 2019. Now you already know that assets are things that you own. Assets, $200,000. Liabilities are things that you owe. Remember the vehicle. $100,000. Owner's equity or worth is the difference. Assets equal liabilities plus owner's equity, $100,000. So you have assets worth $200,000. There's liabilities against those assets. You don't own them totally of $100,000, but you have $100,000 worth of work. Now let's take, just for fun for a second, let's pretend this is you. You've got $2 million worth of assets. You've got $800,000 worth of liabilities. You've got $1.2 million worth. Are you a millionaire? Yep. Congratulations. But I've got a lot of stuff I owe here. That's okay. That's okay. A millionaire doesn't mean you don't owe anything. It means your assets are greater than your liabilities to the tune of $1 million or more. Okay, so let me get off of whether you're a millionaire or not. Kind of get back to these the original figures I put up here. I want you to be familiar with what a balance sheet is. A balance sheet is the financial position of a company at a given point in time. So I'm going to put out here financial condition. on June 30th, 2019, could it change the next day? It could. Something could happen to the assets, something could happen to the liability, something, and it could change the next day. But as of June 30th, 2019, this was the financial condition of that particular company. So I want you to be familiar with that. I want you to be familiar with the fact that assets are things that you own. Liabilities are things that you owe, and owner's equity is what you are worth. Okay? Okay? All right. Now there's a second statement that's very, very important as well. And look at a little something. Let me see if I can find a spot here that I can write a little something about. Income statement shows the results of operations for a period of time. Well, we know something's different here. A balance sheet shows your financial condition as of a particular date. An income statement shows how your company did over a period of time. Now, what's in an income statement? All right, you have revenue. You familiar with what revenue is? Revenue is money received from the sale of goods and services. Okay, you got that. Expenses. Expenses are the cost of doing business. Like what? Utilities, salary. Did I put any of those down here for you? I just said the cost of operating the business for expenses. I'm looking at my study notes. I said an income statement shows the result of operations for a period of time, just like we said. Revenue received from selling goods and services, we know that. Expenses, the cost of operating the business, such as rent, utilities, salaries, that sort of thing. Revenue minus expenses is going to give you your net income or profit. Revenue of $50,000. Expenses of $25,000. Net income, profit, $25,000. So that's a income statement. It shows that during the year of 1 July 2018 to 30 June 2019, you brought in this much revenue. You had this many expenditures, and this was your net profit. I hope this business is a part-time business for you, because if this were a full-time business, you probably wouldn't be living very well on $25,000. So I guess we'll have to make this a part-time business that somebody has, which can be a lot of fun. Okay, what if your expenses were greater than your revenue? You'd have a net loss. That makes sense? You'd have a net loss. I want you to be familiar with what an income statement is, just like I want you to be familiar with a balance sheet. An income statement shows the results of operations over a period of time. Within an income statement is revenue, money received for the sale of goods and services. Expenses, the cost of doing business, such as salaries, utilities, rent, that sort of thing. Revenue minus expenses gives you your net income or your profit. If your expenses are greater than your revenue, it gives you a net loss. Okay, so that's what I want you to be familiar with. I think the only no thing I believe that I have in this chapter is I wanted you to know the 5 different areas of accounting. Everything else was be familiar with things. So let's talk a little bit as we kind of summarize up this chapter. Is this chapter important? If you're going to be in the world of business, even if you don't own your own business, you need to understand fundamental accounting. And I've just, here in this chapter, we've just kind of tasted it a little bit. You'll get in Accounting 201 and they'll get into a lot more. You might say, well, you didn't talk about depreciation and stuff like that. That comes later. That comes later. We just want to get the very basics of why you have accounting in a company. You have accounting to see if a business is going to be successful or not. Okay. These are two different statements. But does one have an effect on the other? I hope that answer was yes. Because here's the thing. Think about it this way. If you, each year, each period of time, if your revenue is exceeding your expenses and you're making a net income, what should your owner's equity or worth do? Probably going to go up. Because if you're making net income and you're making money, that's going to be reflected in additional assets. Because remember, money's an asset. Or buying additional equipment or whatever. Or you could take that and you could reduce some of your liabilities, pay off some of your bills, something like that. But a good income statement, profitability, if a company is profitable, is that going to reflect in a better balance sheet where your financial condition improves? The answer is yes. So if you're ever going to decide, hey, I want to buy into a business, or maybe I want to invest a good bit of money in a particular business, would it be a good idea to see their financial statements? It'd be a good idea maybe to see their balance sheet for the last 2 or 3 years, their income statement for the last 2 or 3 years, to see how they're doing. How are they trending? Not only, hey, the net profit this year was $25,000. So you say, okay, that's good. But let's say last year it was 50 and the year before that was 75. Well, even though it had 25,000 profit this year, that's not trending very well because it's going down. So it's not, the only thing better than seeing a balance sheet and an income statement is seeing maybe 2 or 3 years worth, because then you really get a feel for how things are done, okay, and how things are going with the company. Okay, I think that gives us an introduction to accounting, Accounting 201, Principles of Financial Accounting. I think we've gotten most everything. There's one other, if you happen to see your study notes, there's one other thing in here about cash flow. There's another statement called the statement of cash flow, and that's where you just keep up, where you keep up with the cash coming in and the cash going out. Because you got to make sure that you have enough cash to meet your day-to-day, week-to-week obligations. But that's not something I wanted to put up, not something I want us to be familiar with or know. So I think we've done a pretty good job on this chapter. I'm going to regroup. I've got to go back, let the hairdresser touch up the hair. I've got to get the makeup reworked and that sort of thing. And I'll be with you shortly in chapter 18. All right, good. Thank you. Oh. I forgot. See, I hadn't done these for a couple of days. Professor Pierce always likes a loud noise, so he knows I have finished a chapter before I start another chapter. You know the drill if you've watched the videos in 13, 14, 15, those videos. Okay. So, to make sure that we have finished this chapter, we need a loud noise. So you can shout if you want to, and I will do this. Thank you. See you in chapter 18.